Gold is under pressure this Tuesday. XAU/USD is trading around $4,393, down 0.5% on the day, after buyers failed to hold the $4,450 area. The trigger is not a collapse in demand. It is a surge in US government borrowing costs. The 30-year Treasury yield has now risen above 5.3%, its highest level in this cycle. For gold, which pays no interest, that is a real problem. Higher yields make cash and bonds pay more, so the opportunity cost of holding gold jumps. At the same time, a stronger US dollar, boosted by safe haven flows from renewed Iran war concerns, makes gold more expensive for overseas buyers. The metal is being squeezed from both sides. Only a day ago, gold was holding a bullish bias near $4,400, supported by a weaker dollar and expectations that the Federal Reserve may ease policy. Today that story has flipped. Rising yields are the main culprit. When investors demand higher returns on long-term US government debt, they are saying they need more compensation for inflation and fiscal risk. That shifts capital away from zero-yield assets like gold. The 30-year yield above 5.3% is a psychological threshold. It means the real, inflation-adjusted return on the safest dollar asset is becoming competitive again. Add the Iran headlines, and the dollar gets an extra bid, which is normally bad for gold. So this is not just a technical pullback. It is a macro rotation. Here is where price levels tell a clear story. Analysts at FX Street and others highlight that as long as gold remains below the $4,509 to $4,530 resistance zone, downward pressure is likely to continue. The immediate target is $4,400, and a confirmed break below that opens the door to deeper support near $4,365. On the upside, a pushback above $4,450 would reinforce bullish momentum, but price was rejected there earlier today. The fact that gold has stalled below $4,400 after such a rejection suggests sellers are defending the range. We are in a battleground between $4,365 and $4,450. Until one side breaks, expect choppy two-way flows. The near-term outlook hinges on two fronts. First, yields. If the 30-year yield holds above 5.3%, gold could struggle to reclaim $4,450, and a test of $4,365 becomes more likely. Second, geopolitical headlines. Any escalation in the Iran conflict could support the dollar further, but if the risk tone stabilizes, gold may find some relief from safe haven demand. For today, the base case from the research is cautious, below the $4,509 to $4,530 zone, the bias remains lower, with $4,400 as the line in the sand. A confirmed break below that level could accelerate selling, while a close above $4,450 would change the short-term picture. So the message on Tuesday, August 18, 2026 is straightforward. Gold below $4,400 is not a random move. It is a direct response to the highest 30-year Treasury yield in this cycle and a stronger dollar. Watch 5.3% on the 30-year yield, $4,400 as support, and $4,450 as resistance. If yields keep rising, the path of least resistance is lower. If yields stall, gold could stabilize quickly. Either way, do not chase a move until the level confirms. This is a rate-driven gold market right now.